40 segundos. ¿Me lees aquí en el chat o por el otro chat?
Por el otro.
¿Me lees aquí en el chat o por el otro chat?
I think we're live.
¿Lees aquí en el chat o por el otro chat?
Hi, everyone. Welcome to this event. We are going to cover live the Bank of England monetary policy decision. And as usual, we are here with Yohay Elam from ForexCrunch and Mauricio Carrillo from FXStreet in the background. Hi, how are you?
Hi, Valeria. Doing great. Hope we have some surprises today and some action.
Do you expect surprises from the Bank of England today?
No, I think they'll try to keep quiet because we have elections in 4 weeks in the UK, but you never know what some kind of word or can be interpreted and moving markets. So we have a super Thursday today.
Okay. Anyway, what's the general market expectation for today? Rates and change, and maybe some comments about inflation growth, a revision?
Yeah, so the pound did rise since the announcement about the elections. This should push inflation in the near future a bit lower, relieving pressure from the Bank of England to raise rates. Last time we had one member voting for a rate hike. It was Christine Forbes, so it was 8 against 1. This time we have only 8 members voting. Of course, no changes expected, but this member, she's still expected to vote against the rate hike, so it's going to be 7-1 according to expectations.
Okay, and adding to what you have said, pound dollar quoting around 130 is also easing the pressure over inflation, right? A stronger pound, it's taking off the steam also of the Bank of England.
Yeah, so that's where we are. We still didn't break 130, but it seems close, no?
Yeah, it's there. I'm a bit surprised today that the pair is holding pretty well to the negative in manufacturing and industrial data we had earlier. Ever since the year started, data has been quite soft, to say the least, in the UK. We have an uptick in last month, and we thought that maybe that setback in macroeconomic figures was temporal, but come again, here we are, grow at 0.3% in the first quarter, and poor manufacturing and industrial figures. The market will begin to be concerned about these soft ratings if they persist in time, regardless the elections or even the Bank of England. Moreover, if the Bank of England stays pat and does not hike rates, right?
Yeah, I think with, as you said, lower growth and perhaps lower inflation because of the pound, there's much more pressure to raise rates. And this, I think Brexit is beginning to bite We had, after the referendum back in June last year, we had 2 very strong quarters of growth, 0.6, 0.7, something like that. Now things are beginning to, now Britain begins paying the price. So I don't think there will be pressure to raise rates. If we get a surprise, maybe it'll be that we have a unanimous vote, that all the members vote against changing rates, and this could hurt the pound, send it a bit further away from 130.
Yeah, indeed. I was taking a look at the charts, and pretty much since this May started, we don't have much action in anywhere, to be honest.
Yeah.
And a lot of range bound trading, the sell in May and go away, it's not happening, and we are halfway into the month. But anyway, the dollar remains weak, generally weak, particularly against its European rivals, even despite what the decline we have seen these days in the euro, right? And that's going on even as the market is pretty sure, sort of saying that the Fed will provide a rate hike this June, right? So what's your take for the future of the greenback?
I must say, I don't fully understand this rise of the US dollar. The non-farm payrolls showed a good gain in jobs, but weak wages, still a lot of slack in the US economy. I'm really unsure about the rate hike in June. I think this rise of the dollar is, markets are getting a bit ahead of themselves. I can understand why they might dismiss the political risk, the FBI story. I mean, you never know what's going to come out of the story, but the US economy is just not doing that great. So.
Yeah, indeed, that was a big story. Seems the market is paying less attention to what Trump is doing lately, but still reluctant to give up on his promises about boosting growth and inflation. I don't know. I'm a bit like you, not sure to understand much how the market is seeing the future these days, right?
Yeah, I just watched beforehand an interview with Valeria, and formerly of Pinko, on Bloomberg TV, and he was saying, okay, markets are expecting from Trump to do something in the future, so they're taking the financial risk. I mean, stocks are rising, dollar looks strong, but the hard data, nobody's taking real risks. Nobody, I mean, companies are not building new factories or things like that. So that's a good differentiation between the hard data and the soft data. And buying into Trump, that means buying stocks, but not actually lifting the real economy.
Okay. So what are the levels are you watching on in the pound dollar?
129 to the downside, we've been close to that. And to the top side, we've seen a few challenges. Just under 130, it was 129.87, the recent high. So that's the range.
Okay. I would think if you take a look at the wider picture, I do find the strong support below that 29, around 28.30, right, which is last week low, and below that 27.70, which is the low after the elections announcement by Prime Minister May. So unless we take that 27.70, I don't see much chances of a sustainable decline in the pound. You know what I mean? And on the other hand, if the pair manages to extend above that 129.90, 130 area that has been attracting selling interest these days, I have a short-term target around 30.60. And that's pretty much it, because there's no technical reading that is giving us clues about what the pair can do or not. Moreover, ahead of a big macroeconomic event like it is the Bank of England, right? Anyway, less than 1 minute to go, right? Remember, guys, we have a bit of delay. You will see the reaction first in price, then with us. But here we go.
Yeah.
Votes
15th.
and rates.
Yeah. So it's Super Thursday. Mm-hmm.
Yeah. We had some disappointing Super Thursday so far this last year.
And
Here we go.
No change in interest rates as
Change in
expected.
rates. Yeah, no
Still,
change.
one member voting for rate hike.
Yeah, no changes.
Quite a big
FTSE
fall in the pound.
Yeah, pound breaking lower as an initial reaction. Let's see how it develops. And if we get some clues from the minutes, right? And the inflation report.
Yeah.
Okay, the market was really hoping to see at least two members voting for a rate hike, right? Maybe that's when we had that initial reaction in pound. However, take a look, it's pretty much trimming all of its losses in seconds.
So it's, I guess, only Christine Forbes. There was another member called Saunders who was relatively hawkish. Some expected him to vote also for rate hike. I thought we might have had the other direction, that everybody would line up against moving because of stronger pound and weaker economy. But, well, no change. I guess that's what we have usually.
The pound tried to regain 29 and so far failed, and it seems to be ready to turn back south. So that increases the risk of further declines. I'm not seeing much headlines so far about inflation and okay.
So yeah, it's Forbes. She once again voted for rate hike. So she surprised last time. This time she did not surprise. We have the quarterly inflation report, and the headline that I'm seeing is that the inflation is expected to peak at a level of 2.82 in the fourth quarter of 2017 of this year.
Yeah, 3%, pretty much in line with market's expectation. In fact, analysts are expecting a higher peak of around 2.1%. But, well.
Yeah. So there was some kind of a dovish surprise, but not from the direction of the votes. Okay. Bank of England says we need tighter policy than yield curve implies. That sounds a bit hawkish, but...
yeah, but the market is reacting to the...
The low so far, 128.66. 20 pips above that low, but still well below the pre-rate decision level.
Yeah, but pound is struggling to regain 29. Taking a look at the rest of the currencies, there's nothing going on. It's just about the pound, and of course, pound crosses right now, right?
Yeah. So they did raise their CPI forecast for 2017 to 2.7%, but they lowered it for 2019 to 2.2%. And they raised GDP growth to 1.7%.
That's a bit of a...
yeah, no, that's for 2018. So that's
okay, anyway,
sorry.
It seems a bit too much considering the latest reading, the 0.3% we have in the third quarter we were talking about a few ago, and a bit too much considering the latest data that keeps disappointing, right? And so maybe they are looking too optimistic. They're being too optimistic, sorry.
Yeah. Bank of England says that forecasts assume a smooth Brexit transition. Well, given the political noise we had in recent weeks.
Well,
yeah.
I was thinking that ahead of the Brexit, the Bank of England was forecasting chaos and doom. And then now that we are there and things are getting rough, they are talking about smooth Brexit. So funny.
Yeah, they're behind the curve or reacting to criticism, at least.
Yeah, it seems so, rather than actual thoughts on the matter.
So
I'm looking to see if we have some more relevant things to comment, but there's not much. In fact, I guess the market will be now waiting for whatever Carney has to say in about 25 minutes when he starts his press conference. But remember that in the previous meeting, Carney has left doors open to move either side, right? Or either hike rates or cut rates. He has not a clear posture. We know he favors rate hike, but in his statements, he usually left doors open both sides. So unless he has a clear position this time, he won't be able to add much to what we already knew, and therefore have little effects on the pound and its process.
Yeah, it's called Super Thursday because the Bank of England already releases not only the meeting minutes from the rate decision, but also the quarterly inflation report, which is only once a quarter. So there are already so many words out there that his words, verbal, audio, should not make such a big difference, but never know. So
okay, I guess the market will start to look forward, and in the quite choppy, boring week, I guess the main events for the ahead of a weekend, are inflation figures in the United States, right? We have producer price index today, CPI tomorrow. I was thinking earlier today, right, that as I said earlier, the market is sort of highly betting on a rate hike next June, although not yet confirmed. The market believes it may happen, right? And I'm not sure how much of that it's already priced in what we are seeing right now. So unless we have really sharp surprises to the upside in inflation figures in the US, I don't see the greenback rallying sharply, right? The market is thinking ahead way too much lately, way too much. But I do believe that if inflation is worse than expected, that will have a stronger effect in the market with the dollar easing against all its major rivals, right? Negative news will have a higher impact than positive news when it comes to US inflation, in my view, okay?
Yeah, regarding inflation, last week we got the core PCE price index, the Fed's favorite inflation measure, and there were no surprises there, but it still fell from a yearly rate of 1.8% to 1.6%. So it's getting further away from that holy grail of 2%.
2%, indeed. Anyway, and as we wait for Carney, what's your take on the euro? Where are you seeing it going, or supports, resistance levels to follow?
Yeah, well, euro dollar had, as we all, I guess, talked about, buy the rumor, sell the fact. So we had this false break above 110. I still see 110 as a critical level. To the upside, 108.70, I had that level in mind, but we're seeing now the pair just play all around it. So 108.20, next level of support. That's the first round of the French elections low. And then 107.75, which was the pre-first round high, and then 107.20. To the upside, 109.50 and 110. If we do break above 110, then it's 110.50 and 111.20. But after the nice big gap that we had in the first round of the French elections, movements once again are a bit more shallow.
Yeah, indeed. I'm seeing the same as you. 820, it's a key support for me, because if we take it, the pair can finally attempt to fill that opening gap that we saw after the first round of French elections. Despite this range we are seeing, the bearish potential seems to have increased after the pair peaked at 1020, as you said. So yes, it's going down, and I guess that US inflation data will be key trigger the downward move or not, of course.
Yeah. Tomorrow morning we have German GDP.
Also.
Yeah. So far we had the Eurozone GDP figures without Germany, and they were quite good, 0.5% quarter over quarter, which is 2% annualized, and that's much better than the United States. But of course, if Germany has a surprise to the upside or to the downside, it shakes the whole number once again. Germany is the biggest economy, of course.
Indeed. The pound remains under pressure, unable to regain 129, but the market is waiting for turn before taking more decisions over the pair, right? And what's your thoughts on the dollar yen quoting above 114? Pretty amazing recovery in here. I see that the yen highly linked to dollar and U.S. Treasury yields, right? Alongside with yields still, it has been happening for at least a couple of months. I don't know, that is not strong enough to in the US, I mean, to fuel the rally, but as long as yields keep advancing, the pair has chances to at least retain this bullish tone. We have sort of a very small double top there, just shy of 1450. But honestly, not seeing the pair easing at the time being. I do expect a break of that 1450 level, which in fact is the 23.6% retracement of the November-December rally, when the post-US election rally, right? And so above that level, the pair will look a bit more constructive towards the upside, but still, it will all depend on how yields behave rather than headline news.
Yeah, so far it's been an amazing rally from the bottom. It's over just around 600 pips from the lows. We've seen not that far away, so it's a mix of risk on, thanks to the French elections. The first round of the French elections gave the boost, and then also, as you said, the Treasury yields. Perhaps it's hope that Trump could get the tax reform through after he had some success with the tax bill. On the other hand, we have now the FBI stuff, so I wouldn't tie that too much into politics. It's more expectations.
Okay, not much new, honestly. About what you have said about Trump and the tax reform, much has said that it would come in the summer, right? We are talking about July, August, and then it's going to Congress, and it's still a long way ahead before we actually see the tax reform materialize it, right? So I'm not sure if we can take a look on that at this stage to trade.
Yeah, so 2 weeks ago we had two senior officials, Gary Cohn and Steve Mnuchin, presenting this one page of tax reform, which seemed ambitious but didn't have too many details. And then the following week, focus shifted once again to healthcare reform. We had that vote in the House. So for me, that's a signal that tax reform will wait, but you never know. Trump, jumps from one thing to another. So
yeah. At least we are not getting worried with news coming from the US, although the market seems to, because lately it's reacting less to Trump headlines than it did a couple of months ago.
Yeah. It's a good time to be to write about US politics.
Okay, 15 minutes for Bank of England Governor Carney's speech. Not much going on in the market. The market reaction confined to just pound, right? And its crosses, of course. Little else going on, except maybe that European stocks that started the day with wrong foot are struggling to retain the green, but barely trading in positive territory right now. I was watching yesterday US stocks that We have Dow Jones range bound near record heights, not far away, but the Nasdaq and the S&P pressuring the record highs. The Nasdaq, in fact, it has been setting fresh heights these days, right? So it seems that confidence in the U.S. remains strong. Another thing that we could comment is the fact that the dollar, tends to ease a bit in Asia and regain its footing during the American session, right? That's what the behavior we have seen these past days. So maybe we may see a bit more of dollar strength after Wall Street opening, particularly if the data came positive. Beware of that, guys. And of course, the pound, it's an exception to this today because of the Bank of England. Well, let's see when the market ends digesting whatever Carney has to say.
Yeah, we had action in commodity currencies. Well, more, I would say last week with the crash of oil prices, we had the Canadian dollar responding. So we had dollar CAD almost touching 138. Since then, Canadian dollar did recover, oil prices recovered, but we're still relatively high up there with dollar CAD.
Yeah, 137. The OC is quite weak also, hit by poor PMIs in China a couple of last week, I believe it was, right? Because weaker Chinese data means that China will import less base metals that usually Australia provides, right? And that's what's driving the Aussie lower. And also a neutral Reserve Bank of Australia, which seems concerned about the future, but not willing to act ahead of it and hoping things get better by themselves lately. But anyway, that's the stance we are seeing from low lately, right? So that's pretty much what's going on. However, the OC remains weak, and it's fine, we think, to find a floor around 73.30, 73.50. The risk is, for me, it's still towards downside in the Aussie dollar, particularly because commodities prices weakness. Okay, we have a nice bounce, as you said, in oil yesterday, better than expected. U.S. stockpiles, a sharp decline in reserves, but still that does not erase the fact that the market is concerned about worldwide glut, and U.S. production remains high. So it's still to be seen if oil can continue recovering now. Okay.
Yeah, oil production rose once again in the United States, another 0.2% week over week. On the other hand, we did have these headlines that OPEC and non-OPEC countries may resume their deal for another 6 months, for another 9 months. It's still not finalized, but this also helped oil sort of recover from the deep lows.
Still below 50 as oil, not much. Same.
Yeah, so we had there this triple bottom, 47 or double bottom.
Yeah, I was reading today that the OPEC and non-OPEC producers are pledging or trying to extend their cut for another 6 months. The initial deal has a limit in June this year, so they're thinking of extending up to the end of 2017. But well, there's nothing said and official on that. And I do believe that they meet by the end of the month in Vienna. So maybe then we have some news, more relevant news on oil prices. But so far, as long as U.S. production keeps rising, whatever the OPEC decides will do little for the oil, to be honest. Okay, makers are super still. It's really tough when this happens. I was thinking earlier today that this is a more usual behavior at the beginning of the year. Usually February is a extremely quiet month when you see a lot of range-bound trading and little directional moves. And since this year has been delayed towards May, so
yeah, I think yeah, Bank of England so far sent sort of mixed messages. On one hand, monetary policy could be tightened to a somewhat greater extent over the forecast period, and very gently rising path implied by market yield curve. On the other hand, they said that inflation would peak towards the end of the year. So I think they're keeping things balanced also ahead of the elections.
yeah, there's little they can do ahead of it. What do you think about the elections? Will Theresa May win, as everyone's thinking?
Yeah, I think so. All the polls show that. And one argument goes that because the polls were wrong, so wrong about the conservative win last time, 2 years ago, maybe now they're overcompensating, and maybe Labour will do better than polls suggest, but they still have such a mountain to climb. I mean, so maybe it's not going to be a 100-seat majority for the Conservatives, maybe only 50 or maybe 30, but I think they'll retain their absolute majority in Parliament. And this will give, in any case, it'll give Theresa May her own personal mandate, because she never won the elections by herself, not in her party and not in the public. So
yeah, that will reinforce her strength to deal with the euro area in the Brexit, right? Reinforce the view that the Brexit, the hard Brexit she announced, is what the public wants. So it will be generally positive for the pound, at least as an initial reaction to the election's outcome. Of course, if May wins. But, well, Brexit is still there pending like a Damocles or over the pound's head, right? The euro area seems to be demanding much more than what the UK is willing to give, right? So preliminary talks, unofficial talks or comments seen lately, are have been quite aggressive, right? Both
oh yeah,
and Shankar from the euro area, they have been in a verbal battle in the media, not face to face, but I'm still got this feeling that the euro area is not willing to make things easy for May, and that May is going to came out hurt from this battle because, well, the UK is fighting the rest of the continent back. Well, that's my personal view.
yeah, and it's important for EU countries to show that maybe not punish the UK, but the deal with the UK has to be inferior to what countries inside get. So
Exactly.
yeah, the UK cannot eat the cake and leave it whole, as this expression goes. Or
Totally agree with you on that.
yeah, so I think markets are a bit hopeful that with the fresh mandate, Theresa May will be able to get rid of the Brexiteers, the saboteurs, and get her own strength, her own mandate. She also all the time talks about strong and stable leadership, and they hope for a soft Brexit, for a change. But if what she's doing now with Juncker, and what Juncker is helping her, of course, shows sort of a hard Brexit. Sorry?
No, I agree with you.
Then okay, it might work for getting elected, but it still does damage, I think, to relations with the EU. So, I mean, I think it's good politics in the short term, and not so good in the longer term.
Yeah, and while Scotland has taken a step back in the Scottish exit, right, because of the latest developments on terrorism in the UK, the fact is that in a couple of months, I do believe that Scotland would come back and charge against May, right, and try to to get its own deal with the rest of Europe. So things are going to be complicated for the UK.
Yeah, I think.
Not before, not before elections.
Yeah, so it's 4 weeks to go now, June 8th.
Yeah. I got the feeling we're going to get an entertaining summer.
Yeah.
Opposite to what it's usually.
Yeah.
With UK elections and Brexit and the US tax bill, right?
Yeah, and well, Trump is the gift that keeps on giving in terms of news. So. Well, some summer months have been exciting. 2 years ago, if you remember, we had the Chinese stock market crash in the end of August 2000.
Sorry, I lost you. What did you say?
I said, well, in the end of August 2015, almost 2 years ago, we had the crash of the Chinese stock market, if you remember.
Yeah.
So I think many people were on vacation. Nobody had expected anything to happen over the summer, and boom, we had that. So that was not expected.
Okay, pound state at slopes ahead of Barney. We're going to get him live in the air, right? So, waiting for him to start, okay?
Yeah, it's a few minutes. We also get some figures from the United States. PPI, the Producer Price Index, and jobless claims as every Thursday.
Yeah, well, but an hour later, right? An hour after.
Oh yeah, sorry, an hour later.
Yeah.
Confused with
okay.
the I think an hour later. Yeah, sorry.
Okay, and we have the. Okay, I was looking the NISR GDP estimate in the UK. That's a monthly estimate from a private organization. Sorry, but still, that will probably move the pound also, right? In about 30 minutes, in between Carney's speech, sorry, and US data. Okay, someone's asking if we see the GDP going back into the 130, 134 range, or do we see it dropping down? To be honest, as we were saying earlier, the pounds, despite this latest setback for me, it's the downside is protected unless we have a nasty surprise now from Carney and the pair plugs below 27.70. I do believe that it's going to remain strong. As we were discussing Yohay just now, the pound will probably held strong until or after UK elections, sorry, and then after that suffer, right? But so far, I'm seeing it holding ground. We need to confirm the break higher. What do you think, Yohay?
Yeah, I think everything is a bit on hold until the elections, as you said. Of course, we'll have more data. Next week, we'll have lots of figures from the UK, retail sales, inflation, the jobs report. So we could have a trend. We could, if all the data goes very strongly in one direction, maybe we'll have a break above 130. But usually the data comes out mixed. So one piece of data can be strong, inflation can be high, and then jobs can be weak or something like that. So I think the big political event that is holding back markets is the elections, and then it's in 4 weeks, and after that, it's back to normal.
Okay.
So do we have Carney coming up?
Yeah, we have Carney coming up, so I guess it's a good time for us to make a wrap up and leave a public with Bank of England's governor. So I would start as usual. Wrap up for today. The Bank of England has left its economic policy unchanged. The voting among policymakers was as previous month, with just one hoping for higher rates. The bank also cut its economic growth forecast for this year, but raised 2018 and 2019 ones. Overall, the statement was a bit disappointing for the market and resulted in the pound plummeting, right? FX and the rest. Carney is touching, so I'm saying goodbye. Yohay, if you want to add something before saying goodbye to the people.
No, I think you said everything. So hopefully Carney will move markets, but I think we had so much data out and we had to move the big moves already.
Okay.
So that's it.
Sometimes
okay. Great to being with you. See you soon.
See you.
Bye-bye.
Bye-bye.
EU, those responses have diverged. In its February projections, the MPC expected that this tension between consumer strength and relative financial market pessimism would be reduced over the course of this year. That process has now begun. With wage growth moderating and inflation picking up, both household spending and GDP growth have slowed markedly. In contrast, sterling has appreciated, possibly reflecting market expectations of a more orderly Brexit process. On balance, the committee judges that consumption growth will be slower in the near term than previously anticipated, before recovering in the latter part of the forecast as real incomes pick up. In the MPC's central forecast, quarterly growth is expected to stabilize around its current rate, resulting in growth of 1.9% in 2017 and around 1.75% in each of the next 2 years. This is broadly as the committee had expected in February. Global outlook has improved since February, with stronger business surveys and generally better financial conditions. The latest indicators, including trade growth and capital goods orders, suggest broad-based strength. And signs of a more robust global demand have also been reflected in global asset prices, with equity prices rising further in recent months. The MPC's projection for world growth remains near the top of the range of external forecasters. The combination of a stronger global outlook and sterling's past depreciation is likely to support UK net trade. And together with somewhat lower uncertainty, stronger global growth is also likely to encourage investment as exporters renew and increase capacity. Turning to inflation, CPI inflation has risen above the MPC's 2% target, and sterling's past depreciation has begun to feed through to consumer prices. This impact has been offset to some extent by the continued subdued growth in domestic costs, with wage growth notably weaker than expected. The MPC expects inflation to rise further above target in coming months, peaking a little below 3% in the fourth quarter. Conditioned on the market yield curve, inflation is projected to remain above the MPC's target throughout the forecast period. And I'd note that market yield curve has steepened slightly, and sterling has rallied somewhat since our forecast was closed. The projected inflation overshoot entirely reflects the effects on import prices of the fall in sterling since late 2015, a depreciation caused by market expectations of a material adjustment to the UK's medium-term prospects as it leaves the European Union. The contribution to inflation of higher import prices is likely to fade gradually throughout the forecast period. The extent to which domestic cost pressures pick up will determine where CPI inflation settles towards the end of the forecast. Wage growth has been soft in recent years despite strong employment growth. Weakness in productivity growth and a continuing drag from slack have contributed to this softness, but they can't explain its full extent. Uncertainty of companies about the outlook may have also made them unwilling to raise wages at a faster pace until they have more clarity about future costs and market access. The MPC judges that the factors currently weighing on wage growth are unlikely to persist, and it projects that wages will rise significantly as the output gap narrows throughout the forecast and closes by the end. As a result, inflation is projected to rise in the third year of the forecast, even as the impact of imported price pressures diminish. Monetary policy cannot prevent either the necessary real adjustments as the UK moves towards its new international trading arrangements, or the weaker real income growth that's likely to accompany that adjustment over the next few years. Attempting to offset fully the effects of weaker sterling on inflation would be achievable only at the cost of higher unemployment and, in all likelihood, even weaker real income growth. For this reason, the MPC's remit specifies that, in such exceptional circumstances, the committee must balance any trade-off between the speed with which it intends to return inflation to target and the support that monetary policy provides to jobs and activity. At its May meeting, the MPC decided that the current stance of monetary policy remained appropriate to balance the demands of its remit. The actual and prospective overshoot of inflation relative to target is entirely due to sterling's depreciation, which itself reflects fundamental factors that monetary policy cannot affect. In such exceptional circumstances, the MPC's remit requires it to pay close consideration to the trade-off between inflation and slack. For most of the forecast period, the economy is expected to operate with a degree of spare capacity, justifying that some degree of above-target inflation could be tolerated. However, the output gap is projected to close by the end of the forecast, reducing the committee's tolerance for above-target inflation at that point. The MPC's forecast relies on, amongst other things, a significant pickup in wage growth, no further slowing in aggregate demand, a lower level of sterling continuing to boost consumer prices broadly as projected and without adverse consequences for inflation expectations further ahead, and the adjustment to the UK's new trading relationship with the EU being smooth. As these conditions make clear, while Brexit will play an important role, other factors will also influence the outlook for the economy and inflation. Judging the appropriateness of the monetary stance, the committee will monitor closely incoming evidence regarding a range of factors. Monetary policy will respond in either direction to changes in the economic outlook as they unfold to ensure a sustainable return of inflation to target, while supporting the necessary real adjustments in the economy. On the whole, the committee judges that if the economy follows a path broadly consistent with its central projection, then monetary policy could need to be tightened by a somewhat greater extent over the forecast horizon than the very gently rising path implied by the market yield curve at the time of the forecast. And with that, Ben and I would be pleased to take your questions.
As always, could you please give your name, the organisation you represent, and stick to one question, if you could, please. Thanks. Marina, and then Chris.
Marina Hertz, ITV News. Governor, can you explain in layman's language for our viewers what you're seeing with real wages and what your expectations for wages are over the coming 2 years? Because I know that's going to be a real concern to people.
Well, I think the first thing that people are experiencing across the country, and they have experienced for several years, is that the actual pace of wage growth has been relatively slow relative to past experience. So even though a tremendous amount of employment has been created, wages are not picking up as much as they would have done in the past. That's the first point. The second is that we have expected since the summer of last year that there would be a squeeze on real incomes around this time and basically over the course of this year. In other words, that the wages that people are getting are not going to be sufficient to compensate for the rises in consumer prices in the shop. And so this is going to be a more challenging time for British households over the course of this year. Real income growth, to use our terminology, will be negative. To use theirs, wages won't keep up with prices for the goods and services they consume. I think it's important to put this in context. And the context is that the economy is still growing solidly. The economy is still creating jobs. Wages are still growing, and we actually expect that the pace of wage growth is going to accelerate as this year progresses, and certainly into 2018, 2019. And this higher inflation that we're experiencing now will come off in subsequent years. So real income growth, we expect, will return, and people will start moving ahead in the latter years of the forecast. Now, lots of assumptions and judgments around those conclusions, but that's our best judgment.
Chris Giles from the Financial Times. Governor, you said that the forecasts are dependent on a smooth Brexit, a smooth leaving of the European Union. How dependent are they? How much would the forecasts be worse if we didn't have a smooth exit?
Yeah. So in order to precisely answer that question, we would have had to do an alternative forecast, as you can appreciate, with some variant of a disorderly negotiating process, and we have not done that. So I can't give you a precise answer to that. What I can say is that, as has been the case since our August forecast of last year, we have assumed that the process of leaving the European Union would be a smooth one. What does that mean? That means that there will be an agreement about future trading arrangements, and that there will be a transition or an implementation period from the negotiation to that new agreement. Now, we, like everyone else, doesn't know exactly the shape of what that agreement is going to be. That's why there's a negotiation. And so we have conditioned on a range of possible outcomes. We haven't changed those judgments, that averaging period. But what we do have is an economy which gradually adjusts to those new trading arrangements that happen at some point in the future. In other words, some point after the forecast horizon. And so one of the consequences, and I'll finish with this, of that process is there's a bit of a drag on productivity in our forecast as the economy reorients to those new arrangements. But there is not any sort of sharp break or sharper adjustment. Let's see.
Ed, and then Mark, please.
Thanks. Ed Conway from Sky News. It's kind of really following on those two questions. Can you be specific about whether this squeeze that we're seeing in real earnings that you've just talked about is a consequence, direct or indirect, of Brexit, of the referendum? And just additionally to that, we're kind of almost a year on. Other than that, can you tell us what impacts there have been or haven't been on the UK economy from the referendum vote?
Packed a lot in there. The highly efficient question there. So it's going to be a longer answer. In terms of your first question, which I'll characterize as, is the squeeze in real incomes all because of Brexit? That's a fair characterization. And the short answer is no, because part of the story here is that wage growth has been weak. Now, wage growth has been weak for several years, despite relatively strong, in some respects, exceptionally strong in terms of actual quantities of labor markets. In other words, how many jobs have been created and hours that people are working. We've had quite a strong labor market for several years, and wage growth has been weaker than one would have expected. Now, in our last forecast, part of the way, our judgment has been that actually there's probably a bit more slack in the labor market, but in a more positive way in the labor market. There's probably more people can work more people are seeking work, and the level of unemployment, the amount of jobs this economy can create in a sustainable manner is higher than we thought previously. So that's part of the answer to it. But another part of the answer is we think weak wage growth partly reflects the relatively poor productivity performance in this economy for the last several years, or since the financial crisis. Now, That predated Brexit, and actually what we have seen in the last few quarters has been some modest improvement in productivity performance. So there's two elements there of this squeeze around wages, which are predate the Brexit process. Now, there's one element which is largely the product of the decision to leave the European Union, which is the overshoot of inflation. It's because the currency went down, and the currency went down because of a judgment. I'm not endorsing the judgment. I'm observing the judgment of the market that there would be consequences for the UK's medium-term prospects, and the exchange rate needed to adjust accordingly. So that element is there. The related question, for which there is some evidence, we pick some of this up when we go around the country and talk to businesses, but I wouldn't say it's conclusive. There is some evidence that businesses are hesitating to bring in higher wage costs at a time of some uncertainty about market access and other costs that could be associated with the Brexit process, and that workers, that bargaining dynamic is resulting in more modest wage settlements. But we do expect in this forecast, or our central expectation in this forecast is, despite all those factors, we do expect wages to pick up, and we do expect real income growth to turn positive again over the course of the next few years, and that is during the period of leaving the European Union. So it's not as black and white. Given that I probably used up 2 minutes on that answer, maybe can I stop there? Is that all right? And maybe we'll go for other questions, and if we have time, I'll come back to your other one, if that's okay.
Kamal Ahmed from the BBC. Governor, you've spoken about this sharp squeeze on living standards this year. Why are you so confident that that will come to an end and that wage growth will hit 3.75%, you suggest, by the end of 2019? What are the reasons for people's income starting to rise more rapidly than inflation? And can I also ask, what preparations does the bank do for the possibility of a radical change in economic direction after a general election, for example, towards more public ownership, higher borrowing, and possibly higher taxes for investment? I just wondered what work the bank has to do on the possible outcomes on June the 9th.
Well, we'll start the work to adjust to the new government on June the 9th. So that's the answer to the second part of the question. Let me start on the first question, then I'll hand to Ben in terms of our confidence. First, there's no guarantee here. This is a forecast. It's driven off of the tightness in the labor market, which, even though we think the equilibrium level of unemployment is lower than the current rate of unemployment, we are continuing to add jobs. Average hours worked actually were quite strong growth in the first quarter. So the market's getting tighter. You pick it up in surveys, not just our surveys. You see the most recent REC survey, which was a bit mixed, but did show that in terms of recruitment difficulties, for example, skilled recruitment difficulties, that continues to be above average. So there is a tightness in the labor market. There's some catch up to do for workers in terms of, even though productivity growth has been relatively meager over the forecast, our path for wage growth is below our path for productivity growth. Ultimately, workers share in productivity gains, and so there should be some catch up there. And then I guess the third point I would make, which is that, again, we're conditioning on a smooth process, smooth Brexit process, as we have been since August. That's not new. But to the extent to which that is the case, and the extent to which uncertainty over that process is temporarily weighing on wages, that should dissipate. I wouldn't overplay that point, given the conditions I put around my answer to Mr. Conway. But Ben, do you want to?
No, I think I understand most of it. One small thing I'd point out is just to be precise about wages and income. So real wages are falling this year, real incomes in aggregate are not. That's because we've got some employment growth, and it's also got to remember that almost half of household income is not wages, from some various other things, including pensions, both public and private, and those are running slightly faster. So that's one small thing. The only other thing, two other things quickly to point out. One is that the squeeze that's coming from rising import prices doesn't last forever. The governor said we're seeing it pretty acutely right at the moment, but it does sort of dwindle over the forecast period, and that contributes to a rise of income growth in real terms. And the last point to make is about that nominal wage growth. It has been weaker than we had expected on many occasions in the last 2 or 3 years. That's why the committee earlier this year lowered its estimate of the equilibrium rate. We still think that the tightness of the labour market means something for future wage growth. So, it was weaker again in Q1, even weaker than we had expected after lowering that equilibrium estimate. But we still think that that will help some recovery of growth of the nominal
Sue, and then David. Sue Chan from the Telegraph. Your forecast projects more balanced growth over the next 3 years with stronger business investment and exports. Does the bank welcome that? And to borrow the words from Ed Broadbent's speech, can this sweet spot last?
Okay, well, I'll let Ben expand in a moment on this sweet spot. Certainly it's welcome to have more balanced growth. It still has to come. I mean, this is a forecast. I'd say a couple things of context. First, we see some pickup in investment and some positive contribution from net trade for most of the forecast, but this is not, it's not booming. We have, I think, investment growth is roughly half of past averages. Net trade, export growth, kind of 1 3/4% growth, 2018, 2019. So, and particularly with respect to the latter, to some extent the former, relatively modest given the scale of the depreciation, given the strength of the global economy, and this is a partial answer to Ed Conway's question earlier, as some of the, not listening now, but that's getting better, so I can say answer his question. But a partial answer to that, that's part of the Brexit. There's a Brexit judgment there, is that for some exporters adding capacity right now, if they're tightly linked into a European supply chain about which there is some uncertainty, makes less sense. We're not just saying that theoretically. We know that from talking to a series of companies around the country. It's not surprising. And then on the investment side, I think you definitely get some of that effect here. So the point I'm making is there's more balance. You're absolutely right. That is welcome. But this is not; these are not big numbers in the grand scheme of things.
No, I think that says it all, really. I mean, I think the point I was trying to make in the speech is that the exchange rate is weak in anticipation of something that hasn't happened. So for the time being, or on the face of it, what are pretty propitious and helpful conditions for exporters. Nevertheless, as the governor said, allowing for the strength of the world economy, investment, the level of investment at the start of the forecast is quite low, given those conditions. And while we're expecting it to grow, our forecasts are not that strong. So there's some rebalancing.
Yeah, David.
It's Sunday Times. Governor, going back to wages, the forecast that you're making of quite a strong recovery in average earnings growth does seem puzzlingly bold, given that you expect the equilibrium unemployment rate to be at or above its equilibrium right through to the second quarter of 2020. And surely that is the appropriate measure of slack to take into account when you're looking for wage pressure.
Well, it's not, David, I think as you know, I mean, it's not a binary thing. Historically, we've actually, in the UK, there's been a pretty well-functioning Phillips curve, wage Phillips curve in this economy. I think there has been a question of whether there's been a level shift given where the equilibrium level of unemployment or rate of unemployment has gone. It's a pretty different people have different views. Certainly some on the committee think it may be lower than where we settled. Some think it's potentially higher. but it's a pretty well researched view of when we drop the level of unemployment. But it's not as if, to get back to my broader answer, it's not as if you magically start to have wage pressure and wage pressure consistent with productivity growth and some productivity growth and inflation at target. Because in the end, I mean, we're talking about 3 3/4% wage growth, I think, by the end of the forecast. Productivity growth, a little less than 1 3/4, let's say 1.5, 1 3/4, I think, by the end. Inflation a bit above 2. Normally, when you get back into equilibrium, which is where we are by the end of the forecast, you would expect in a perfect world, and of course there's always lags and means and things, but in a perfect world, that you would see productivity plus inflation be normal growth. So you'd have normal growth above 4. And on top of that, there is some productivity catch up to be done. Workers in our forecast aren't getting paid for the productivity boost that we expect, or aren't being fully compensated for the productivity boost that we expect in the intervening 3 years, as long as they get back towards running at roughly the rate they should. That's a very theoretical model-based answer. The sort of real economy answer is actually, we've got 4.7% unemployment, we've got very high participation, average hours are picking up, we've seen some recruitment difficulties. There's a variety of reasons to expect wage growth to be stronger. There's some inertia in that market. There's some historic productivity weakness, and there may be some uncertainty effects that are weighing on it as well. It's also possible equilibrium of unemployment is a little lower. I'm not saying that, but it's also possible I can look at it over time. But there should be some build, and whether we have it precisely right on the film.
Hugo, and then Phil.
Bednarik from the Daily Mail. Governor, you've spoken about the impact of the exchange rate on inflation. I wonder what impact you see the oil price having on inflation and the recent falls in the price of crude, and how that might affect the squeeze on finances, family finances this year.
Yeah. Well, it's always dangerous to update forecasts in real time because Brent will be below 50 and then above 50 in the course of the week. I think rule of thumb, it's about probably relative to the closing of the forecast to the trough of the oil price, which was sort of 8% off or so. I'm going from memory in terms of the conditioning assumption. It's probably 0.1 off. I think the important 0.1 off inflation sort of out to a year. And I think one of the important things to think is, so that, that's something. And then also there's an exchange rate effect, which again, it has to persist, and also the curves a little steeper and all these things. You could always update the forecast. So if you don't want to get too much into it, on the oil price, so there may be something given back from the oil price if it remains at a lower level to British households. From a monetary policy perspective, that's likely to come through relatively quickly and not over the policy horizon. So it's interesting, it's welcome, but it's, and I'll make one other point actually, which is, since it would appear to be supply driven, if it does persist, it's actually stimulative. But obviously we're not banking on it. We'll deal with it in August if it persists. And it also doesn't really shade policy, because you're reacting to something that happens, and that you would be reacting to something that's over by the time the full force of your policy move takes effect.
Phil Aldrich at the Times. Governor, inflation is above forecast. There's unemployment. We've got economy growing at around trend rate. The output gap is closing. I just wondered how you can justify excessive stimulus at these levels, and what does it take for the bank to raise rates? Are you simply worried that households just can't stomach a rate rise?
Well, first off, where to begin on that? The stimulus isn't excessive; it's appropriate. First point. Secondly, and that's the judgment of the committee. Secondly, the inflation is above target. Why is inflation above target? Inflation is above target because the exchange rate went down 16%. Why did the exchange rate go down 16%? Largely because of the decision to leave the European Union. Okay, that's a market judgment. I'm not endorsing the judgment, but that's the market judgment. That's the flow through. Question is, do we lean against that and lean against something which has a real underlying fundamental aspect to it? Something we can affect. We're not changing monetary policy is not going to change the future trading relationship between the UK and the European Union, or the UK and other countries. Those decisions are going to be taken quite appropriately by governments. In terms of the economy is not at full employment. The economy is above full employment. And the output gap, part of the reason, to move back to the start of my answer, part of the reason why the output gap is closing over the forecast is because monetary policy is appropriate. Now, we have said that we used a conditioning curve for the forecast, as we always do with convention. We just take a 15-day average at the time we freeze or finalize the forecast. In that curve, there was 125 basis point hike in interest rates over the course of the next 3 years. Judgment of the committee was that that's if the forecast is coming to pass, that's too little, and then we would, if things unfolded as per the forecast, you would expect us to withdraw some more monetary stimulus over the course of the next few years. But that's withdrawal of stimulus or raising of interest rates, to be precise, to a modest extent in a positive economic environment where the economy is growing above trend and we are closing the output gap.
Ben, Chief Independent Governor, you've revised down the savings ratio again in these set of forecasts, and you've put a technical annex sort of suggesting why that isn't quite possibly as alarming as it might look. At the time of the March budget, your former colleague, Sir Charlie Bean, struck a very different tone. He said that the falling savings ratio highlighted the fact that in his view it wasn't sustainable. Not sustainable was his view. Do you disagree with that, or is it a question of nuance? What's going on?
Well, I'm going to allow my current colleague, Dr. Broadbent, to discuss the nuances of the saving ratio, and I'll just preface it by one's got to look at a difference between, there's the direction of the savings ratio, there's the statistical reporting of the savings ratio, and there's the cash and non-cash elements of the savings ratio. All of these are relevant, and it takes a very special, and to some extent sad individual to be fully versed in all aspects of it, and fortunately we have one here today. Ben.
I'd make a distinction as well between the level of the saving rate, and Charlie may or may not have been talking about that, but I suspect he was talking about the decline in the saving rate. And there's no doubt that to the extent it's true, I'll come back to that in a moment, that the saving rate was falling in the second half of last year. From whatever level, that's unlikely to be sustainable for very long. And even our forecast is roughly flat. When it comes to the level, unfortunately, it's very difficult to make a judgment, even in normal times, I would say, or most of the time, because the level is often revised. And what we alert people to in the box, page 16, is that we know we're going to get quite big revisions later this year in the blue book, which will generally be upwards. And those might also change the slope, the recent slope. So I completely agree with Charlie. You're unlikely to see, in the end, this thing can't fall forever. And you get a period in which it falls steeply, and you can be pretty sure that it's not going to carry on doing so very long. When it comes to, and that's the case in our forecast, it sort of flattens out. When it comes to level, though, I'd be very wary about making judgments about what is or isn't sustainable, what is, because we can't be really sure in real time what that level is.
And that's some final thing, which is to sort of link some of the questions in your question, which is the forecast does rely heavily on a recovery of wages, a pickup in wage growth. So it's not a forecast where consumption is softer and then sort of U-shape consumption over the consumption growth over the forecast. And it's not a forecast that relies on It's not a debt-fueled consumption growth, is my point. It relies on wages. It doesn't rely on the savings rate going to zero and negative. And so it's obviously people can ask whatever they want, but it's entirely appropriate to focus in on what is happening with wages, what can be expected to happen with wages over the course of the next few years, because it's absolutely one of the key judgments. We expect wage growth to pick up. If it doesn't, that has consequences.
From CNBC. Governor Carrillo, you've spoken in the past about the threat of automation. And I appreciate that this is a secular trend,
right,
but it's one that's arguably accelerating and a potential paradigm changer. How do you reconcile this with such a buoyant view of the labour market going forward?
Well, it's a couple of things. I mean, it is something we do look at secular trends because there are a few from time to time, and one can think of China's integration to the global trading system as being a classic example of the previous decade. There are a few secular trends which actually impact consistently on inflation prices in this country, and therefore monetary policy has to take into account. It is possible that at some point automation, use your term, machine learning, other terms, that will have those impacts in the UK. It's possible. It's not yet clear that that is the case. And what is clear is that the UK labour market, to use your adjective, has been buoyant. It has been very strong. This is the strong. There's more people employed in this country than ever before. Employment growth continues to be strong. As I said in my remarks earlier, average hours growth, not just jobs, but the amount of hours people are working has also ticked up smartly. And again, in terms of the pickup in wage growth, this is not, yes, it is faster wage growth by the end of the forecast, 3.75% than we have been seeing. It's not especially fast wage growth. I would keep that in mind as well. So the question's on point. It's the type of thing we think about, but I wouldn't say that we're in a period of time. You can just see that from actually the employment numbers, where there's wide-scale displacement of work as a consequence of these bigger trends.
Richard.
Richard Barney from Wall Street Journal. Governor, the bank sounds quite upbeat about prospects for global growth. Could you just talk a little bit about the risks around that, the way markets are responding to it, and perhaps also the balance between stronger global growth and tighter monetary policy around the world?
Sure. In terms of risk to global growth, we have I would say there's a slight skew to the downside net on global growth. Now, that's starting from a position where we are near the top of consensus in our global forecast. That was the case in February. We've upgraded a bit more this time around, so we've remained there. So again, I put it in context. One of the medium-term risks, and of course medium-term risks are always medium-term risks until they crystallize, and then they're also near-term risks, do relate to the rate of growth in China and the adjustment and the necessary series of adjustments in that economy, which are from the manufacturing to services sector, from external demand to domestic demand, the shifts that are necessary in both the property market and very much in the financial sector, and some of the pressures that exist in an economy that has very, very high levels of private debt. None of those all of those issues are well known to the Chinese authorities, and they have plans and put them in place, and we've seen some moves in recent weeks consistent with those. So that is one of the bigger risks. In terms of, I won't presume to make any judgments about other people's monetary policies. I think the thing to watch for all of us in a global context, and very difficult to, you can have lots of false precision about this, and we wouldn't presume it, is that and if I'm going to finish with a sort of positive global scenario, which isn't assured by any stretch, but in a positive scenario where broad-based growth becomes the levels of uncertainty coming down, if we start to see a pickup of investment, private investment relative to savings, there could be some upward pressure on global equilibrium interest rates, which in and of itself will give monetary policy more traction on unchanged policy. And that's something to watch for over the horizon that affects all of us. The one last thing I'll say on that, though, is that I think we should all remember, and the bank, colleagues at the bank, Rachel and Smith, have done a lot of work. I would recommend if you haven't seen their work, that decomposes the effects on equilibrium real interest rates, R-star, I use the shorthand. And the bigger effects on that are broader forces, demographics, other forces, than just the savings investment, the investment stance per se. But with that caveat, one could see a rise, and one would hope to see a rise in R-star over the course of the next several years, which has some consequences for the path of policy.
Hello, Simon Viger. My views. Governor, you said that hopefully next year or the year after wages will catch up. In your view, is that going to be anywhere near enough for people that are struggling to make ends meet right now?
Well, it's, I think the first thing is to recognize that the economy is starting a period of adjustment. And the first thing to make ends meet is to have a job, and so part of this is making a judgment in exceptional circumstances that we're in, that we have an appropriate stance of monetary policy, so that people are in work first, and as many people are in work as possible, and that's why we are tolerating this overshoot of inflation. Because the origin of that overshoot is the exchange rate, and the origin of the exchange rate move is this future adjustment to the relationship with the European Union. So first and foremost, we make a conscious decision, at least for a period of time when there's a trade-off between people being in work and inflation being a little higher. It's better to have people in work. I obviously. Every household situation is different. It will be a more challenging time over the course of this year, but it is a time where we continue to see, in our view, job creation and the prospect of wages picking up. And this higher inflation is temporary. It is temporary. So I think households can, well, I would put some store on that, but I wouldn't diminish the issues that some people will be facing.
Holly Williams, Press Association. Looking at the pound, given its recent rebound since the snap election was called, do you think that this means the worst is over for the pound in terms of the falls that we saw, and also this recent rebound? How much has this limited the surge in inflation? Say?
In terms of the second aspect of that, in fact, it's sterling on.
It was up 3% since February, so it would have had at the margin some depressive effect on inflation towards the end of the forecast. It's still the case, as the governor pointed out at the beginning, that the reason for the overshoot relative to target essentially is still that import prices, even at that stage and even after sterling's rise, import prices are rising faster than usual and pushing up on inflation at that horizon. It would have been slightly less marked than was the case 3 months ago.
Governor Harry Daniels, Live Sport News. The tone today seems to be a bit more upbeat and optimistic from the MPC statement on the state of the UK economy. With that in mind, one part of the question was, have the markets fallen behind the curve in terms of rate rise expectations? And from the MPC's perspective, is looser for longer a less risky option than a premature withdrawal of stimulus?
Well, first, Harry, from the MPC's perspective, at least in the judgment of 7 of the 8 members of the MPC, the current monetary policy stance is appropriate to achieve our remit. The second thing, though, is that we will, the committee will set, as you would expect, we're going to set the appropriate stance of monetary policy to balance our remit under exceptional circumstances. I think one thing I'd sort of dispel, that the Article 50 process, the negotiation process, it is that process and that end state, of course, has an influence on the economy and inflation. But it does, and we have to take that into account and set monetary policy appropriately, and that's what we're doing, and we're explaining it as best we can. But it does not tie the hands of the MPC. The MPC will take the necessary monetary decisions at the appropriate time in order to get that balance right. Now, what we said with, and just by one way of illustration, with this forecast is that we have, in our best judgment, if the market, if we follow the path consistent with the market curve at the time we made the forecast, I know that's a mouthful, but which basically was 125 basis point rate increase over the next 3 years. The judgment of the MPC is that inflation would not be returning sustainably to target. In other words, it would have come down and it would have picked up and domestic costs would be building. And for that reason, we would expect, if the economy were on that path in broad terms, that we would withdraw some more stimulus over the course of that time. And of course, over that period, that's still during, or 2/3 of that period is still during the Article 50 process as defined in the treaty. So I guess I've just used your question as an opportunity to make that, which I think is a pretty basic point, and a point that most, and you asked the question from a market perspective, most in the market would appreciate.
Hi, my name is Matthijs Schippers from the Dutch Financial Times. Theresa May wants to reduce immigration to below the 100,000. That might make the labor market even tighter than you expect now. At the same time, it may dampen growth. Do you take lower immigration into account, and to what extent?
Well, the first thing is that what we do for a forecast is we take the estimates of the ONS for net migration into the country, and we just, they're the experts, they make the estimates, we take them, we report them in, we use those. And so we don't make an independent judgment about either future government policy or the effect of future government policy. The second thing is that I'll get my dates wrong, but I believe it was November 2015, it might have been, it was in 2015 in a similar report. We did an analysis of the effect of change in labor supply on wages. And you go up and down by, I think we used 100,000 in normalization. We can get you the background. The point is that, sorry, the effect of labor supply on inflation, which in the end is what we ultimately have to worry about. And changes in the overall level of labor, whether they come from domestically, more people coming into the labor market, or net migration. Most migrants, the labor market outcomes of migration are similar to domestic workers, that are a little higher actually. It's a relatively modest impact on inflation, around 10 basis points, order of magnitude. And the reason is that you supply more labor, it has a dampening effect in the labor market, but then there's more demand, and that has a tightening effect on prices and wages, ultimately cycles through the economy. So that's all, I can understand maybe in the Netherlands you didn't follow this as closely. That's all sort of old news. So we just take a specific forecast of somebody else about net migration. We just use that, and then separately in terms of the overall shifts and the impact on what we care about, what we're mandated to care about. Obviously, we care about labor market outcomes, but what we're ultimately, our ultimate remit is it's a relatively small effect. Last thing I'll say, obviously, for certain sectors and areas can be incredibly important, but there's a process which others run for those areas to make their views known to the government.
Joe Ward from Bloomberg News. The inflation report mentions that certain measures of domestically generated inflation are starting to pick up. How much weight do you put on those at the moment? Does that make the overshoot in inflation harder to tolerate? And also, could you elaborate on how they're expected to pick up as an inflation report says near the end of the forecast period? Thank you.
Okay. So we look at a range of domestic DGI measures, domestically generated inflation measures. And there, I think at least we list some of the summary in the report, as you know. First thing to say is that it's actually hard to get a pure domestic measure, which is part of the reason why you look at a range. When you look at them as a whole, they have been relatively subdued. If you look at, they picked up in recent quarters. If you use, for example, a principal component, which is a way of extracting the core message from a series of indicators, the statistical technique. If you look at the principal component of those DGIs, they are still below levels that are consistent with inflation being at target. So why is inflation above target? It's above target because of the exchange rate, et cetera, what I've been saying. We do expect them to pick up, as you know, over the course of the forecast horizon. So the drag that they're exerting on the rate of inflation diminishes over the forecast horizon. It doesn't fully extinguish by the end of the forecast horizon. It's still a very modest amount by the end of the forecast horizon. But virtually, you can see that we would expect that them to be consistent with target as a whole. But
it comes back to this judgment on wages, essentially. And I think that's what's necessary. And in the forecast, at least, the key measure of domestic costs that drives that a unit labour cost. So it requires the wage growth pick up, and in particular that it moves above the rate of productivity growth.
So maybe I'll just make a general point, which is that if you like the look of the forecast, and we're not marketing it, but if you like the look of growth, the rate of growth, and the employment performance of the forecast, we're going to see a period where we're starting to see domestic costs pick up, wages pick up, unit labor costs pick up, other domestic measures pick up, when inflation is still above target. Still above target again because of the exchange rate. It's a good outcome. That is a good outcome. That's what we want to see. Is that we start to get that domestic traction, reflation, if you will, domestically, as the external side is starting to come off. And obviously, we have to calibrate monetary policy appropriately during that period. But that is those are positive developments for the sustainability of this expansion.
Ivana Stahazi from German Business Week. You said that your assumption that your forecasts were based on the assumption of a smooth Brexit, including a transition period and so on. I was just wondering if this assessment is a bit optimistic, given that Mrs. May seems to be heading for a hard Brexit, and we've had various statements from the European Union and also reports about this infamous dinner at number 10 recently. And what would it take for you to, change your assumption, to adjust it?
Yeah. Well, I think the first thing is that the stated objective of the UK government, the Prime Minister, is a bold, comprehensive trade agreement between the UK and the European Union, and furthermore, that there is a period of implementation, appropriate period of implementation, to go from where we are today to that agreement being in place. And you know, the stated view of President Tusk on behalf of the European Council is that it's in everyone's interest to avoid a disruptive or disorderly process. There are negotiating mandates, well known, public negotiating mandates for Mr. Barnier and for the other principles that are consistent with a process that will lead to an agreement. So that is the objectives of both sides, and it's not our place to call those into question. There also is, I think we all know, it's we haven't between now and March 26, 2019, for these negotiations to get underway, and it's very early days in the whole process.
Jasper Jolly from Citi AM. With volatility on markets around the world at kind of historical, well, pre-financial crisis lows, and markets at kind of record highs, do you think there are risks around your forecasts if markets pull back from some of these highs and volatility rises?
Yeah. Well, the first thing to say is that volatility is, as you rightly point out, is quite low across a range of financial markets. In sterling land, actually, and particularly in sterling, volatility is probably closest to its historic averages, 5-year average, than any other currency pair, with maybe the exception of the Canadian Aussie dollar, maybe up there as well. Now, there's a variety of potential reasons why volatility would have been reduced, and those range from the broad, the phase in the economic cycle we are, where it's a broad-based acceleration in the global economy at a time when not seeing the inflationary pressures. There range from that to improvements in the resilience of the core of the financial system, to potentially volatility strategies or yield enhancing strategies of real money investors selling a lot of volatility. That's a more market technical thing. But I would not say that we would have a complete explanation for why volatility is where it is, nor would we make a specific prediction about when it would necessarily adjust. But yes, I mean, there is. One would expect the world hasn't become dramatically less uncertain, and certainly can see some potential triggers for increase in volatility at some point. Now, how will that affect the UK? One of the things we do at a different part of the institution is to make sure that actually the core of the financial system is managing its risks for a much higher level of volatility, credit spreads, other actual credit losses. We do that through stress testing, so that's been core to our stress testing approach, and we feel reasonably confident that they're in a good position for that. So that's one way to mitigate it.
And we're out of time, I'm afraid. Thank you very much for coming, everyone.
Thank you.